So is this it, the big correction the Bears have been expecting? Let me guess that the floor show traders are going to say, Liz, it's only 1.5% lopped off from the Dow Jones Industrials, which is still, since the election, up about 30 or 42%. Not bad. The New York Stock Exchange CME Group were there on those floors, and we're bringing in the man who's been warning to watch out for this very scenario we see unfolding, Natalliance Securities Global Fixed Income Head, Andy Brenner. Andy, to you first. Late last night, I was woken up, I saw your note, and it had quite a specific warning. It will be a very ugly open on Wall Street, and sure enough it was, specifically because of what you saw spiking rates. Is it as bad as you expected? Is it about to get worse?
Liz, it's about to get a lot worse. You have a lot of things going against rates right now. As you pointed out, you've broken the 2 5/8, 265 level in 10 years. You got up to 274. We have 280 as next support. And then the December 13 highs of 303. We're going there. You know, the Trump stimulus package, the Trump tax package, the infrastructure package to be announced tonight. The Fed is on a warpath. Janet Yellen era ends tomorrow, and Powell will be a lot more aggressive. Plus, the other central banks of the world, both the BOJ and the ECB, are backtracking. Liz, we've got a perfect storm, and it looks bad if you're long interest rates.
That's the question. And as you look at how the market opened, Matt, down on the New York Stock Exchange, we saw the biggest gap down at the open. I believe it dropped 182 points right as the opening bell hit. That's the worst, I believe, that we've seen since May. Is it because there was such fear that these companies, which have basically been borrowing money at such low rates it's almost free, are now looking and saying, oh, that's about to change?
Well, that's certainly one of the things. You know, we talked about the close last night. That was an ominous sign, as clearly we saw a close on the lows, and it was fast and free-falling. So this morning that continued. This has been an orderly sell-off, though, today. So it's really got to do with rates, and people are a little bit panicked and they're spooked because we haven't seen this broad-based sell-off in quite some time. So, you know, this is something that, you know, we're up 6%, you know, so far in 2018. So let's take this with a grain of salt. Let's see what comes out tonight. You can't be that worried about, you know, a market move of maybe 2% total if this, you know, continues throughout the day.
I guessed it. I knew that one of you guys would definitely say that. It's true. Larry, we still have the S&P, and I was just looking right before the show, up about 31% since Election Day. So this is not the worst situation in the world, but could it be the start, as Andy mentions, of something that starts to snowball?
Well, you know, it could. I mean, Andy made some really good points, although I disagree. It's not about the yield. Treasury yields are rallying for the right reason, not the wrong reason. Let's not get all excited about the U.S. dollar dropping. That's about global macro balance, not about financial instability. You know, this whole thing started last week when I was on the show talking about Texas Instruments, Union Pacific, and Caterpillar, and how they had very good earnings, and yet the stocks just fell out of bed. I just think it's the fact that there's too many weak hands holding stocks. As Andy mentioned, we're up 6% on the year. The market has just gone up too far and too fast.
Well,
what's troubling... Yeah, go ahead.
No, I was going to say, McDonald's came in with some very good numbers, and they've got the buttermilk chicken tenders that have been selling so well, but it wasn't enough for Wall Street. So, Andy, we've got both of our traders saying it's let's say it's broad-based, it's calm, it's orderly. Is it about to get worse? And if you say yes, why?
Well, if this is to me, Liz, I think the equity market, I don't think this is the beginning of the correction. I do expect a correction this year. I expect it to be in the range of 10%, but I think it starts more, you know, towards in the summer than it does right now. But as far as the bond bear market, it's there. You have new record highs in 5 years. You haven't been this high in 5 years for 8 years. 7 years, you haven't been this high in 7 years for 7 years. And I think the 10-year breaks, and once you start seeing that 3% handle sustained, I think it's going to be a problem for stocks, but it's not a problem today.
All right. Well, who knows if the pullback is definitely stoking fears of volatility, but some people like volatility. Matt, Larry, Andy, great to have you in that perspective. And yes, when Andy's note came out last night, oh my God, we better get up early and see what's happening.